Most people look at one number when their paycheck arrives, the amount that landed in their account. Everything above that number, all the lines showing what was earned and what was taken out and why, gets ignored. That habit is understandable because the deductions can look complicated, but it is worth correcting. Your pay stub is a detailed record of exactly what happened to your earnings before they reached you. Understanding every line on it means you can verify that you are being paid correctly, that the right amounts are being withheld, and that you are not leaving money on the table through misconfigured tax elections or missed benefits. This video walks through every component of a standard pay stub so that none of it is unfamiliar. The first concept to understand is the difference between gross income and net income. Gross income is the total amount you earned before any deductions are taken out. If your salary is $50,000 per year and you're paid bi-weekly, your gross income per paycheck is approximately $1,923. That is the starting number, and it represents what you earned. Net income is what remains after all deductions have been subtracted. Net income is what actually gets deposited into your bank account. The gap between gross and net can be substantial, and understanding what fills that gap is the entire point of reading your pay stub carefully. The largest category of deductions for most employees is taxes. There are several different taxes withheld from your paycheck, and they operate independently of each other. The first is federal income tax. The United States federal government taxes income on a progressive scale, meaning higher portions of your income are taxed at higher rates as your income rises. The amount withheld from each paycheck for federal income tax is determined by your gross pay and the information you provided on your W-4 form when you started your job. The W-4 is a form you fill out for your employer that tells the payroll system how much federal tax to withhold. If you have it configured correctly for your situation, your withholding should closely match what you actually owe when you file your tax return. If too much is withheld, you receive a refund. If too little is withheld, you owe the difference. Taxes will be covered in depth in a later module. For now, the important thing is recognizing the federal income tax line on your pay stub and understanding that it is determined by your W-4 elections. The second tax deduction is state income tax, which applies in most but not all states. Some states, including Florida, Texas, Nevada, Washington, Wyoming, South Dakota, and Alaska, have no state income tax. If you live and work in one of those states, this line will not appear on your pay stub. In states that do collect income tax, the withholding is calculated similarly to federal tax, based on your earnings and state-specific elections you provide on a state withholding form. The third category is FICA taxes, which stand for the Federal Insurance Contributions Act. FICA taxes fund two federal programs, Social Security and Medicare. Social Security tax is withheld at a rate of 6.2% of your gross wages, up to an annual wage cap that adjusts each year. Medicare tax is withheld at 1.45% of your gross wages, with no wage cap. These deductions appear as separate line items on your pay stub, labeled Social Security tax and Medicare tax, or sometimes combined under the FICA label. Your employer pays an equal matching contribution on your behalf, so the total contribution to these programs is double what appears on your pay stub, but only the employee portion shows up in your deductions. For higher income earners, there is an additional Medicare surtax of 0.9% that applies above certain income thresholds, though this is less commonly relevant for entry-level workers. Beyond taxes, there are voluntary deductions that come out of your paycheck based on benefits you have elected through your employer. Health insurance premiums are among the most common. If you are enrolled in your employer's health insurance plan, your share of the monthly premium is typically split across your paychecks throughout the year. Depending on your plan, this amount could range from a modest deduction to a significant one. It appears as a pre-tax deduction in most cases, meaning it reduces your taxable gross income before income taxes are calculated, which effectively makes your health insurance contribution slightly cheaper than it would be if you paid it with after-tax dollars. Retirement contributions are another category of voluntary deductions. If your employer offers a retirement plan, such as a 401k or a 403b, and you have elected to contribute, the contribution comes out of your paycheck each period. Traditional 401k contributions are pre-tax, which means they reduce your taxable income in the current year and grow tax-deferred until you withdraw them in retirement. Roth 401k contributions, if your employer offers this option, are made with after-tax dollars, meaning no immediate tax reduction, but the money grows tax-free and qualified withdrawals in retirement are not taxed. Retirement accounts will be covered in full detail in Module 3. For now, what matters is recognizing the retirement contribution line on your pay stub and understanding that those dollars are being directed into an investment account in your name, not simply disappearing. Other voluntary deductions you might see include contributions to a health savings account or flexible spending account, dental and vision insurance premiums, life insurance premiums, disability insurance premiums, and contributions to a commuter benefits account. Each of these represents a benefit you have elected, and each one reduces your net pay while providing some form of coverage or tax advantage in return. If you see deductions on your pay stub that you do not recognize, the immediate step is to contact your HR or payroll department for clarification. It is not uncommon for employees to be enrolled in benefits they did not fully understand or to find billing errors that need to be corrected. Your pay stub will also show year-to-date totals alongside the current period figures. Year-to-date means the cumulative total of each line item from the beginning of the calendar year through the current pay period. These numbers are useful for tracking how much you have earned and how much has been withheld in total across the year, which becomes relevant when you file your annual tax return. At the end of the year, you will receive a W-2 form from your employer that summarizes your total earnings and total withholdings for the year. The numbers on your W-2 should match the year-to-date figures on your final pay stub of the year. If they do not, that discrepancy needs to be resolved before you file your taxes. Your pay period is the length of time covered by each paycheck. The most common pay periods are weekly, bi-weekly, meaning every 2 weeks, semi-monthly, meaning twice per month, and monthly. Bi-weekly is the most common for hourly and salaried employees in the United States. It is worth noting that bi-weekly and semi-monthly are different. Bi-weekly means you receive 26 paychecks per year because there are 52 weeks and you get paid every 2 weeks. Semi-monthly means you receive exactly 24 paychecks per year. This matters for budgeting because a bi-weekly schedule produces 2 months per year in which you receive 3 paychecks instead of 2, which can be a useful windfall if you plan for it. Hourly employees will see their pay calculated differently than salaried employees. An hourly employee's gross pay is calculated by multiplying the number of hours worked in the pay period by the hourly rate. If an hourly employee works more than 40 hours in a work week, federal law under the Fair Labor Standards Act requires that overtime hours be paid at 1.5 times the regular hourly rate. This overtime premium will appear as a separate line on the pay stub with its own rate. Salaried employees receive the same gross pay each period regardless of the exact hours worked. Those salaried employees classified as exempt under the FLSA are generally not entitled to overtime regardless of hours. One of the most practically useful things you can do with your understanding of your pay stub is verify that your W-4 withholding is configured appropriately for your situation. If you're a single filer with one job and no unusual financial circumstances, the default W-4 configuration is usually reasonably accurate. If you have multiple jobs, significant investment income, large deductions you plan to itemize, or a working spouse, your default withholding may be off in either direction.